Hi guys, today's episode is about Warren Buffett's latest acquisitions, which surprised us with a large movement of its kind in a company or sector in which he did not usually possess, which is the technology sector, especially HP, and the name of its index is HPQ. In particular, the strange thing is that this move came at a time when experts threatened to collapse, as we talked in a previous episode about Robert Kiyosaki, who gets rid of stocks and invests in gold and cryptocurrencies, while Warren Buffett buys shares. So in this episode we will see this buy and most importantly why. What we noticed is that Warren Buffett, of course, via Berkshire Hathaway, bought $4.2 billion of the value of HP, the company famous for printing, laptops, and others. And this represents more than 10%, about 11.4%, which means a large share that is good enough, and this also means 120 million shares at a price of $34.91 per share. Of course, right after the purchase, we notice that the stock has made a terrible jump, 10%, as you can see here in the news. But what matters is why Warren Buffett bought HP stock. This is what we should see in the following sections. But the first thing we notice is that, as mentioned, Buffett has historically avoided tech stocks, especially before Apple, to the point where he invests not in Tesla, for example, but in his holdings of course are relatively simpler companies. The second thing to pay attention to is that Warren Buffett's investment company, Berkshire Hathaway, delayed buying at the beginning of the corona crisis, while now it is making successive purchases, for example, this news that we talked about earlier and how they invested in a bank related to Bitcoin, and then a month and a half later, we get the news of HP. But what is the reason for buying? Now I do not want to disappoint you, but they have not yet announced the reason, but in this episode we will try to analyze the stock to understand. We begin by noting HP's business model, which can be said to be divided into two parts. The printing department and its accessories and the personal systems department, which are laptops and desktop computers for companies etc. In general, as you can see here, the revenues of the printing department are $4,381 billion, and the growth is small, even negative, to constitute 28% of the total revenues, and it is a non-developing sector. But note that it achieves a very good percentage of the operating profit at 48%, although, as we said, it achieves only 28% with the operating profit margin 18.2%, which is very respectable. And the opposite picture is the personal systems department. As you can see, its revenues are greater, $12.196 billion, which constitutes 67% of the total revenues, in addition to an annual growth of 15%. It is a growing sector, so a very strong growth and constitutes most of the company, and it is good that most of the company is growing. But although it constitutes 67% of the revenues, it constitutes 52% of the operating profit, and therefore, you can say that his profit margin is lower, and in fact it is, which is only 7.8%. So we have like the opposite scattered image in which sweet and bitter. So that was for the company departments. Now we are filled with where the company is heading lately. They have a very good annual growth, especially with the COVID jump, as you can see in the graph from the beginning of 2020 to now, and they also have a strong presence in all world markets. They have 40% of sales in the Americas, 35% in the Middle East, Europe and Africa, and 25% in Asia, including China and Japan. It is good that they have a strong presence all over the world, especially the Asian market, which that is true only 25%, but the growth in the Asian market is very strong. If we notice their growth in the American market is just 1%, 8% in Europe, while 30% in the Asian market, you can say that the catalyst for future growth is the market Asian and personal systems sector in this company. All of the above related to the business model. Let's move on to the financial statement. We'll start by analyzing the income statement. Total returns are increasing, but units sold are decreasing. By the way, you won't find units sold on income lists, so instead you should look at the annual report on their site. Well, what is important if revenue is growing and units sold is declining? Remember what the returns equation is. It is the price of the piece multiplied by the number of pieces sold. If the price of the piece rises, the total returns rise, and if the number of pieces sold decreases, the total returns decrease. With this company, we see that the total returns have increased, but the units sold are down. We will first look at the overall growth of these returns, which may be temporary as a result of the increased demand for computers and their accessories for home work during the pandemic. Tailwinds, I mean, during the pandemic, many technology companies of this type increased their sales because people sat in their homes and created a home office, they had to update their computers, and so on. Will it continue? God knows. But it is true that the total returns are growing, but the sold units are declining. What is the indication of this? As we can see the numbers here, in the printing division, hardware units sold 28% less annually. Personnel systems units down 9% for notebooks. But how did the overall returns improve? It may indicate an improvement in the company's pricing power, and this is one of the things or indicators that matter the most to Warren Buffett, which is that the company is strong enough to impose the price it wants. Of course it imposes the price it wants because, for example, it has technology that its competitors do not have, or the customer has strong loyalty, meaning even with higher price buys, etc. The second thing, which may be that the units sold are going down, but the total returns have gone up, is that the product mix has changed, and this means that HP, through marketing and advertising, convinces its customers to buy the most expensive goods. But when we move to the second level of thinking, as the powerful investor Howard Marks says, with a deeper analysis, you don't just look at the number. As we said, it could be temporary, and it could be double improvement, and the most dangerous could be a sign of weakness and growth, but it is covered by inflation. I mean, it is true that the total returns as a number rose, but as the value itself did not rise, because of inflation, all prices are rising. This is what must be verified, and it appears that Buffett looked into the matter and came to his personal conclusion. The second thing about the income statement, which is a nice thing, is that the gross profit margin is growing, and this is good, and it indicates, as we mentioned, an improvement in the product mix and an increase in prices or an improvement in manufacturing. I mean, they did not raise their prices and did not convince their customers to buy more expensive products, but simply sell the same thing with the same price, but they were able to save on manufacturing costs. This is very nice, especially from what we know. I mean, notice a strong profit margin, as this graph shows, and a very nice rise, even though most of their sales come from the personnel system sector, which has a not very nice profit margin. The evidence that the profit margin is growing with the personnel system sector shows that this growing sector is in the process of transforming into a profitable sector as well, very beautifully. So nice reference for HP. Now we're done with the income statement and move on to the balance sheet, and that's where the not so good stuff begins. So you have relatively weak liquidity indicators. What I mean is current ratio, quick ratio and cash ratio. And these are indications of the amount of cash or assets that are available so quickly within a year. This is just a simple glimpse. For those who want to know more about these numbers, their meaning and details, write to me in the comments and we will block an episode to explain them in detail. Weak liquidity indicators indicate what? Currently, it is not a direct risk, and this is because if it were a small company with these numbers, the situation would be dangerous, but due to the large size of the company, it is stable, and its business model is good. I will say that it is an indirect risk, but it is not a good sign because it indicates a weakness in the ability of the company has to deal with emergencies, meaning if something happens they do not have enough cash or quick assets, and the second thing is the inability to take advantage of opportunities. If they find a very cheap and very good company and they want to acquire it, they do not have enough money for that. The second thing, which is very strange and it is a loan and investment lesson, is that shareholders' equity is negative, which remembers the balance sheet episode during which we said that equity is when liabilities are subtracted from assets. And the logically negative result means that liabilities are greater than assets. Does this mean that the company has more debts and dues than she owns? Yes, dear viewer. Does this mean that the value of the company is zero or bankrupt? Of course not, dear viewer. This case is in front us. It is very rare in the companies listed on the stock exchange and it is not possible to generalize because its understanding differs from one company to another, but in general it means that liabilities are more than assets and usually because of the accumulation of losses, especially with startups. If you find this, run away immediately. But in HP condition, it's a little different. It's just that in 2016 the company was divided into two companies, so that we have the HPQ and Pindex, both of which are HP companies, but with differences. The one that Buffett bought is this HPQ, and upon splitting, a large part of the assets went to the other company and a lot of debt was owed to this company, and with all this they continued to distribute profits and buy shares by spending from their financial reserve. This is the reason, and overall my personal assessment of its balance sheet is that it's not very beautiful. Let's monitor the situation with cash flow, perhaps things will be better. Well, with cash flow we find two signs, one is good and the other may be good and may not. The good sign is that free cash flow is large and with great growth. Look here in the graph between 2019 and 2022. Even if we look at a 5-year period, We find it with growth, and as you can see in the last period with a strong rise. This adds security to the company, because the free cash flow is what the company uses to expand, to pay debts and solve problems. In addition to achieving freedom for the company, it means that it can invest in growth by opening new factories or getting rid of its debts or distributing profits, with good things for free cash flow. But whoever looks at the cash flow sheet will notice that the financing cash flow in it is something strange because the cash distributed, if it is by buying shares or distributing profits, is greater than the free cash flow. What does this mean? This is an indication that they are exploiting their reserve, meaning that they are trying from their cash stock other than what they achieved this year in business in order to do what? In order to distribute profits and buy back their shares. Therefore, we see that the company spends more on the distribution of profits and the repurchase of its shares than the free cash flow. As you notice with me here, cash dividends paid minus 1,000 almost means almost $1 billion, and also the repurchase of common stocks bought a lot of their shares despite their free cash flow less than that. If you add them together, you will find that they are greater than the free cash flow number. And this shows us two things. The good thing that Warren Buffett may have seen is that the management can be very confident in the company's future and see that the share price is much less than its fair value, so the opportunity should be used and its shares repurchased, reducing the number of shares offered. This means that the supply has become less and the demand is constant, so the price will rise, and this is a way to reward investors, and it is very beautiful. But you will notice that HP for 2 years and its share price has increased. It may be like IBM, and here's the problem, and the management's shame with this strategy is trying to inflate the share price to shine its image. And all this for the present time. As for the future, in 2022 company guidance said EPS or earnings per share will be less than 2021, but more than 2020. Its annual free cash flow is less than 2021, but more than 2020, and these fluctuations are normal. But it is generally a large and stable company. And so we come to the conclusion of our simplified analysis to understand why Warren Buffett bought this stock. The company is growing, especially in the personnel systems sector. The company's profits and returns are improving, although personnel systems gross margin is still not very high, but it is growing. And the company buys itself, as we said that they went back to buy their shares, and this thing raises the share price and rewards investors without paying tax, and this is beautiful and may indicate confidence from the management. In addition to the company's strong presence in the global markets, and it has a good free cash flow. But on the other hand, we did not notice a growth in the printing department. The second matter may be temporary growth due to COVID. In addition, the company's purchase of its shares may be to raise the share price, not more, while harming the business. And the last important tip, don't just buy because Warren Buffett has bought. If you find a different analysis, write to me in the comments. What do you think of the points I mentioned, and what do you think is the good or the bad direction? If you liked the episode, do not forget to subscribe, like, and share it with your family and friends. Rashad, the presenter of your program Hit the Road to Fire, was with you. See you soon.